Welcome to yet another episode of Voices of Vayana. Today, we have with us Mr. Ambika Ravi, who is a transformational leader with over 30 years of experience in corporate banking and transaction banking in India and South Asia. She has been in leadership positions with large and reputed Indian and foreign banks and has immense expertise in corporate and institutional lending, structured trade credit, trade finance, and supply chain finance. Ambika has joined as the MD and CEO of Vayana Finserv, a group entity of Vayana focused on collaborating with financial institutions to facilitate and grow supply chain finance to medium and small enterprises. Thank you so much for agreeing to be a part of our podcast, ma'am. Welcome.
My pleasure, Akshay.
To start off, can you please walk us through your journey in the banking sector? What were some of the key milestones?
Okay, on a lighter note, as a student, I wanted to become a doctor. However, I ended up taking commerce and have been administering diagnostic on the corporate financial health instead. I did my education in Pune, and the college timing for the commerce stream in Pune facilitated the concept of earn while you learn. Hence, I started my banking journey with Syndicate Bank immediately after the graduation. And during postgrads, besides working, I also started prep for probation all India exam. Was lucky to get offer from three, including SBI. SBI being my mother's fan bank. My two elder sisters were already in SBI. So I opted for SBI. Well, it is a joke. SBI PO job at that time was considered to be a prized win, and I opted. SBI undoubtedly is one of the best training ground to learn banking. Post 2 years of extensive training in all areas of banking, I was the first PO to get posted as an advances officer in Asia's largest advances branch, that is the commercial branch in Horniman Circle, Mumbai, which gave me a wonderful exposure of managing many top industrial houses. Commercial branch posting of SBI, I would consider, was a key turning point which paved my course to corporate lending. SBI, of course, had the policy of rotating its offices to various locations, and I was eventually asked to move to a rural segment. However, by this time I was married, two small children, and was not keen to move. Realizing that my growth in SBI will be restricted due to my immobility, I moved over to SCB, that is Standard Chartered Bank, as a relationship manager in advances. This was the next turning point. Journey with one of the growing foreign banks. SCB was indeed a great experience with varied exposure of being a senior banker for large industrial houses, foray into commercial real estate finance, building the supply chain financing for the bank. In fact, SCB emerged as a global leader in SCF. Then I was the head of trade for India, which time India revenues surpassed even that of Hong Kong, which was the global leader in SCB. And finally, of course, as head of transaction banking products for India and South Asia. 21 years of my banking career, very well spent in SCB. The next turn came in when IDFC Bank got its banking license in October 15, and I was invited to set up the emerging corporates business, and I joined them in 2016. Basis the success of the mid-market business, I was mandated to start the MNC business for the bank. And in 2019, IDFC Bank acquired First Capital, and their focus shifted from erstwhile wholesale banking to retail segment. And that is when I parted ways. So these three banks have etched my journey in the banking segment.
Got it. That was quite an insightful whole journey that you took us on. So, ma'am, moving on, with over 35 years of experience in corporate and transaction banking, what are maybe some of the significant changes that you have observed in the BFSI industry throughout your career?
Well, Akshaya, scale and size of transaction has undergone a big change. With global frontiers and economies opening up, international trade has been facilitated by open frontiers. Banks emerged as a key link to facilitate this trade. Corporates too have been growing in a big stride in their respective fields and compete globally, as India has been attracting global companies to set shop in India. In fact, ability to access competitive funds beyond the home country, sophisticated and competitive modes of financing, as well as structured trades to de risk their balance sheet have been the emerging requirements. Technology, too, has played a significant role in the ease of doing business, combined with more stringent ESG and compliance and regulatory guidelines.
Got it. Okay, ma'am, now going back to something that you had mentioned, in your first answer, as someone who has worked across these various segments of corporate banking, how do you, tailor your approach when dealing with emerging corporates as compared to multinational corporations?
Well, Akshaya, each segment of corporates have a distinct buying behavior. For instance, if I were to approach a new MNC through a foreign bank, okay, we will ideally trace its history to the country of origin or where it is headquartered, engage through a counterpart at the headquarters level to onboard the MNC in the home country. The risk will be covered through affirmations from MNC parent through a letter of comfort or a letter of awareness, and the subsidiary will get its facilities, though it may be a new startup in the country where the performance track record is not yet established.
Yes.
Whereas for a private bank or a PSU, ability to bank a new MNC in the country will be far more difficult as they do not have the past experience of the parent's ability to honor the commitments on behalf of the startup subsidiary in times of stress. However, once a company builds traction and has a credible track record, private banks will aim to get them onboarded and woo them with heightened technology, service, ease of doing business, cross sell other solutions with competitive rates, etc. MNCs, due to their well set out policy guidelines and articulated parental support, is therefore considered as a better risk as compared to the emerging corporates. However, for an emerging corporate, we have to dive deeper into the risk profile of the company with respect to promoter, his history, track record, rating rationale, past performance, industry matrices, competition both locally and globally through imports, etc. Their selling pattern, buyer profile, type of product, customization, so on and so forth, and then set up facilities strictly based on the customer profile, nature of activity, cash flow capture through bundling of facilities, etc. Hence, the due diligence, ongoing monitoring, watch on intercompany dealings, etc., are far more stringent in the case of emerging corporates. That's the key differential.
So, ma'am, client centricity is often compared to diagnosing a patient's ailment and providing the solution, right? Like in healthcare. So, how do you approach understanding your client's need and challenges akin to identifying the real pain points and structuring the solutions then accordingly?
See, client centricity is as effective as knowledge of the client. Ability to understand all the levers of the business and impact of each lever to the success or failure to the client business is absolutely critical. Thus, in-depth knowledge of the client, the industry that he is operating in, the demand and supply of the product or services that he is engaged in, entry barriers, competition, is it a sunrise or a sunset industry, is what will help in deciphering the client's emerging requirements and suggest timely solution which is directed towards protecting the health of the client. For example, emergence of the cell phone spelt the death knell of players manufacturing camera, torch, etc. So one needs to anticipate what is happening in the market based on new developments. We therefore need to at all times know the pulse of the company. What is their formula for success? What are the pain points? How can I solve his issues? And is the solution sustainable, etc.? The key, therefore, is to understand the problem and solve the same through appropriate solutioning. Solution selling is the recipe and not product selling.
Understood. Got it. So, balancing sales objectives with credit considerations can be challenging, right? So, how do you ensure that your solutions not only meet the client's needs, but also align with their risk appetite and credit policies of the organization?
Akshaya, firstly, the credit underwriting standard or credit policy of any institution has to be a dynamic document in tune with the industry norms, competition, market, demand supply, risk factors, law of the land, or the central bank guiding norms. It has to be refreshed based on the ground reality from time to time, considering the various forces at play, and has to be relevant for the business to operate and succeed. Credit and sales are partners with the same ultimate objective of facilitating and building a robust business for the institution to grow in a rightful manner, protecting the risk at all times. Having created a healthy credit framework, it is the sales role. Understand the client requirements and only offer that solution which will comply with the credit policy, appetite of the institution, regulation of the land, and which is beneficial to the client and the organization at large. In my words, there is no shortcut to success, and compliance with the set out policies is not negotiable. We do compliant business or walk away from that seemingly interesting opportunity. No compromise to our agreed framework, for sure.
Ma'am, now just moving on a little bit, with your background in both, client coverage and product management, how do you foster collaborations between these two functions to deliver comprehensive solutions to your clients?
Well, product management sets out the guide or the framework for the appropriate solutioning for client requirements. I would say both are necessary ingredients for a successful client relationship. Through client coverage, you understand the specific nuances of the industry in which the client operates, their financing need, how technology can help, and what is the client's requirement. The product knowledge will assimilate all the above factors and suggest a suitable solution which will meet the client requirement in the most optimal manner. Hence, client coverage and product management are joined in the hips to give the most suitable solution to the client.
Understood. So, ma'am, having navigated through, different market conditions and economic cycles, what are some of the, maybe critical lessons that you have learned about managing risk in transaction banking, and how do you really balance risk with innovation?
Having the ears and eyes to the ground realities is very critical to take timely action. The pulse of each business has to be known by being vigilant to every development in the marketplace, which could impact your client performance. Every significant event in the economy could have a bearing in the portfolio that you have financed and hence need to be stress tested against that event. Innovation in technology of deciphering various data coming from various touch points does help in getting timely whiff of the early warning signals. We have to have an eye for that. Rubix, for instance, has a wealth of data not only on the client but its peers and competing players in the same industry. Combing through the data for any signals or patterns emerging and taking cues for timely action is now facilitated through scoring models and trends. We have got to adapt to this data analysis, which can actually help us in a big way. We can also make extensive use of in-house technology and digital platform to significantly lower the cost of operations and facilitate a robust credit outflow.
And ma'am, just before we come to the end of the podcast, on a lighter note, I just had a final question for you, which is what advice would you give the young team in the organization and maybe the youth who are just starting off in the industry as well?
Aksha, for the eligible youth who are here, who have started their career in Vienna, my messages are simple. One, I would say you are in the right place. The financial ecosystem is becoming more and more digital and embracing newer technologies on an ongoing basis to facilitate ease of doing business with the most optimum efficiency, cost, and accuracy. Vienna has all the verticals catering to the financial ecosystem, and each of the verticals is adding huge value in the marketplace. Never stop learning. Knowledge is power and is a ladder to your success. Innovate and let your ideas be heard. Never give up trying. However, seemingly the issue in hand may be difficult, a positive attitude and a will to win will lead you and the organization to great heights.
Great. Thank you
That's
so
my
much,
message.
Sam, for agreeing to be a part of our podcast and sharing your very, very valuable insights. It's been a pleasure having you. Thank you so much once again.
My pleasure, Akshaya. Thank you.